Hi, we're back once again. My name is Josh Mahoney, Chief. This time around to talk all things China by DK, Chinese marketing consultant. Nice to have you on the podcast, DK.
Hi everyone, I'm very happy to be here, invite here and to stay with Josh. 大家好，我是 DK， 很高兴今天能在这里跟大家一起讨论一下中国的市场经济。谢谢。Thank you.
Great, thanks a lot. So this is a great time to be talking about all things China because we've seen an absolutely incredible rally in terms of Chinese stocks.
Yeah.
It feels like the Chinese market was so unloved and everyone just presumed we'd see more of the same. We saw deflation out of China. We saw low growth expectations under the weight of fears around the credit crisis, around the real estate sector. But people were waiting for that thing to tell them that it's over, and seemingly they think that it's happened this time around, that the Chinese government and the PBOC have been quite cautious with their stimulus in the past. They've implemented a little rate cut here, a little measure here, but it's never been this big wealth of stimulus that we've seen this time around. Do you think that this marks the beginning of a new stage when it comes to China? Are we now seeing the beginning of the end where everyone should be excited for the old China to come back?
Yeah, I think that is like a good time to talk about this topic. And as you can see, the China governments, they gave us a lot of measures to boost the China markets, like lower the central bank rate. It's obviously you can see the result, especially for the China stock markets. They goes up very incredible. But I think it also depends on a lot of factors in the global economic. So I can't say they will goes up, but let's see.
Yeah. Well, look, I mean, the stock market is not the economy, and we know that time and time again. You know, you can see massive rallies in the equity markets and in the middle of COVID off the idea that it's going to be over, or you can see markets rolling over in a meaningful manner and the economy is doing well. And certainly I would say that the moves we've seen within China recently are more based on speculation of what might come rather than what is happening right now. It takes a long time for these measures to really play out within the economy, and I would say that whether it's now or whether it's down the line, we're likely to see those sort of real optimistic sentiment really start to temper and people start to look towards the data. And I think Chinese data is going to be even more watched, even more keenly followed as we go forward, because we need to see that these measures are enough to drive us forward when it comes to the Chinese economy. Certainly there's a lot going on in the world right now, but we've now just heard once again out of China. It's an interesting time because we've just come out of the prolonged holiday in China, so that means that the mainland Chinese markets were closed. We still saw the Hang Seng, so we've seen this big catch-up play, limit up moves in mainland China, but we've seen weakness in terms of the Hang Seng. And that comes off the fact that we've seen an appearance this time around from the NDRC, and they didn't come out with new measures, right? And there's this feeling where we need to constantly hear about new stimulus from each and every individual that comes out of China for the market rally to continue. So I guess the outlook from here, do we expect the rally to continue, or do you think that soon we're going to see it calm down a little bit and we can sort of take stock, I guess?
I would like to say it depends on a lot of factors. I can't say the economic will goes up very quick or like a stable period time. Is hard to say. But a lot of people, they compare back to 10 years ago, like 2015. They think that is a circle. Like even for the stock markets, the property markets, a lot of markets, they think that is a circle year. Like to compare with the time in like 10 years ago, they think is circle, that is another circle. The economic will goes up.
As we come back up again. I think that historically, China and the real estate sector has gone hand in hand, right? the huge boom we've seen in terms of real estate valuations has provided many people with that leg up in terms of their social status, in terms of their financial status. And it sort of felt like as long as the property market kept rising, so people's net worth would keep rising. But when we see the property market coming down in such a meaningful manner, it not only hurts businesses, but it hurts individuals, it hurts their ability to go out and spend in the same way as maybe they would have confidence to do in the past. I guess my feeling from the recent measures from the PBOC would be a lot of it is geared towards, say, banks lending, for example. So what is the bank reserve requirement? How much capital do they need to keep? And therefore that dictates how much they're able to lend out, right? Things like that allow them to lend more, but it comes down to demand as well. So do Chinese consumers or potential homeowners have the demand to say, oh great, now the bank's willing to lend to me? Or maybe it's a demand issue anyway. Even if the bank offers you a loan, you're not willing to take it because you don't have that confidence. So hopefully this surge we've seen in equity prices and the big sort of story around China at the moment would encourage people within China to take those measures, maybe purchase a home where they might have not previously, or go out and spend more money. So do you think that these measures are just for businesses, or do you think that the people on the ground will change their consumption habits?
I think they're gonna change the consumptions. As you guys all know, in Shanghai especially, we have like a property limitations. You can't purchase any properties without Shanghai citizens. If you have to be a Shanghai resident, then you can buy a property in Shanghai. But now the loosened policy for Shanghai citizens, they got like people got more chance to buy a property in Shanghai. It's not like like before. They just released this policy like last month. So let's see.
Yeah, that's really interesting, because I guess part of that, I mean, just off the top of my head, I would think that that would benefit their expansion. China always seems to have new cities popping up and huge development projects around the country. If you only have one or two central hubs that everyone's investing in, I guess in England it would be London, right? And they want people to be able to invest and to be able to grow across the length and breadth of the country. And certainly there's a question mark to be had about the strength of demand for, say, Shanghai property versus a sort of tier 2 or tier 3 city where perhaps there's not the same kind of demand. So it'll be interesting to see exactly whether this drives assets into those sort of major hubs, and whether the other regional areas maybe suffer as a result, or whether that's not the case, and maybe this is just, once you start seeing one area booming, then people start to invest in another area and another area as you go forward.
I think people can see the Shanghai property markets will go up. They think they can build more confidence for Chinese people about China property markets. As you know, like 30% of China GDP actually comes from property markets. So Chinese government is very careful about this part. So that's why they have a lot of policies about the property things, like loosen policy about the buy a property in a specific city, and they also reduce the mortgage rate as well. So I think they will give property market like a boost.
Yeah, I mean, I guess this, for many people out there, sort of highlights the huge disparity that you've seen between, say, US markets, which have huge valuations, you know, because we've got these big tech names and they promise huge growth. You've got 22, 24 price to earnings ratio in the US. In China, perceived to be much cheaper, 11 price to earnings ratio. And so people are suddenly waking up to the fact that this could be the time for them to jump into Chinese equities, Chinese stocks in particular. There is a concern in the lead up to the US election that maybe the US election could bring around potential policy shift, that if we see Donald Trump coming back into power, that might not necessarily be beneficial for relations between US and China. I know full well from my time as an analyst and covering markets over the 4 years that Donald Trump was in power, I was speaking every single day about US-China relations, US-China relations. And so I would say that this period of time in the lead up to the election might actually ordinarily provide some sort of jitters or calm and not necessarily see this boom. The stimulus coming ahead of the election means that, of course, we have seen this big boom in Chinese markets. I wonder if there might be some caution that comes into play as we lead into the US election, just so that we know who's going to be leading the US, and that might shape US-China policy going forward.
I don't think they will affect too much, because China, as you can see, especially on the tech part, US don't provide any chips into China. Then Huawei step out and we develop our own chips. So I think China government currently now is more pay more attention into internal boost first. Then so.
Yeah, I mean, that's a really interesting one, because we've been talking a lot over recent months, in particular, where we're talking about the European Union are taking measures against Chinese EV imports, the US doing the same kind of thing, chip sales from the likes of Nvidia, that they're restricting it into China, and that to some extent puts a lid on people's view of Chinese companies. But what it does do is it forces them to develop their own product rather than buying the US product, right? And so then down the line, all of a sudden you see many of these Chinese companies that are going to be major competitors of these big US tech names, of the EV names, and certainly, like BYD, Tesla are trying to do their best to try and stave off the competition with BYD, but it's likely that they're going to start setting up factories in other locations, be it Mexico to be able to gain access into the US, or somewhere within Europe to be able to access the European market. So some of these hurdles that you might see at the beginning, I think it's likely that these Chinese companies will fight their way through it, will find different ways to be able to reach a global audience. And at the same time, when you're talking about the potential for the domestic consumer in China to continue to grow and come back into strength, so these Chinese companies can position themselves to both perform well on a domestic level and also internationally so as well. So I think from a China-specific stock perspective, you're seeing the sort of beginning that global investors are getting interested. And you can see that with the Hang Seng, because the Hang Seng is predominantly international investors. But you're also seeing that in terms of the local markets, where you're looking at the Shenzhen, the Shanghai, predominantly dominated by Chinese investors. And when you're seeing strength across the two, so you see it reflected that the global community and the domestic community both getting on board with this. The Hang Seng, interestingly, pulled back quite heavily today. We saw the domestic markets doing well because we've just come back off the national holiday, so it's playing catch up to an extent. We might see a little bit of calming down at some point, we don't know, in the lead up to the US election. But I would say we're probably moving into a period of time where, we will see some calming down where we wait for the Chinese data, but it's really a position where traders need to know whether to jump in now because they don't want to miss out on any more gains, or wait for the pullback to be able to then jump in once again once they see the economic data really proving out. We don't know whether that will immediately. Measures take time to push through, right? You don't announce a measure and next week the economy is boosted. So this could take time, but I think it's going to be a really interesting market to follow for scope markets traders and traders around the world. Certainly the Chinese markets are going to be here to stay and going to be one of the major themes going forward. If you're looking at the Chinese market and you're seeing that as a view of the domestic consumer in China and how strong they might be, that also has implications when it comes to, say, energy markets. And we've seen that with the weakness we've seen in the Hang Seng today because we didn't see any more stimulus measures. We saw oil pulling back 2%. So there's wider implications at play here. But when it comes to the indices, when it comes to Chinese stocks as well, this is going to be a big one to watch. Thanks a lot for joining me, DK, for this last one. And that wraps up our coverage today from the FX Expo here in Dubai. I hope you've enjoyed it. We'll make sure to post all of these videos for you to be able to consume it at a later point as well. My name's Josh Mahoney, Chief Market Analyst, and thanks for joining us on this latest podcast.